The NASDAQ and the S&P notching all-time highs today. Dom Chu joins us on set with all the details. Finally,
here. And at opposite ends of the day, Joe. Normally we're always together in the
but usually not in the same location. This is why it's fun.
Apart.
Yes.
This is fun, and I always love being with these guys, especially on a record day for stocks.
Okay.
It is a record day for stocks. So if you take a look at where the standouts were in this whole move higher, today it was about the financials, and those financials, not just the money center banks like Citigroup and JP Morgan, but other big ones as well. Take a look at some of these gains that we've seen, the big bank breakout, and what you're seeing is a chart for those who are listening on Sirius XM radio. JP Morgan so far this month up 15%. Morgan Stanley, not a money center bank, but still 15%. Citi 14%, B of A 12%. You get the idea. If you look at today's trading, it was the financials, that sector in the S&P that really led the way higher as well. And what you are seeing right now is perhaps a bit of a breakout. And when I say that, I mean if you look at the KBE, which is the Spider Bank ETF, or the Spider Regional Bank ETF, KRE, both are now trading above their 200-day moving averages or their longer-term trend lines. All of these banks set up for what could be a bullish narrative, only because the financials have been underperformers over the course of the past year-to-date period and one-year period as well. So, Joe, I guess the point being here is if you were looking for some kind of a reason to be more bullish on the overall market, it is that financials had not been part of that leadership hire. They are right now. The bears will say, well, they're playing catch up, and this is the sign of a top. But, I mean, the earnings season was pretty solid. The beats were better than expected, so maybe financials have their day. I would say this, and Joe, you've heard it before, how many guests have come on our air over the course of the past 2 or 3 years saying that financials were due to break out, and they've just been kind of sitting there for a while. So that's kind of where we stand right now, and I'm not sure exactly.
It helps to go to the charts in a case like
this. It does.
You know what, we should do. Thanks.
Great idea,
with the market, with the market sitting at record highs, our next guest says there's still 2 names that are worth a buy. Chartmaster Carter Worth. Nothing Gets By Me is over at the Plasma to break it down. Hey, Carter.
Hi there. Sure, there are more than 2, of course, but I've got 2 good ones, I think. And first, let's talk about where we are in relation to where we've been. What we know is the following, that the market peaked on September 21st, and here we are 7 months later, basically the end of April, and the S&P today got slightly above its high of September 21st and actually closed almost near the low at 29.43, so we're 2 points above the prior high, whereas almost every major aggregate from the transports, you see here, the Russell 2000, obviously has not done that. That's either the problem with the market or the opportunity, meaning there are people who believe that these have catch-up potential and that this sort of super cap-led rally in the S&P will be followed up by others. But I think the more important thing is, independent of that, is try to find individual securities, if you can, that have lagged and that maybe have potential to catch up. So let's try to do just that. But first, the S&P chart, we are exactly back to the high. It's a virtual V, down and up. And this leaves us with the following setup. Here is the sequence. It looks a bit busy, but take a look. Up, 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 up. That's 1, 2, 3, 4, 5, 6 advances and 5 declines. The sequence here calls for your next decline. Doesn't make it bad or good. If you're bearish, you think the decline won't be 3 to 5%, it'll be 15 or 20. And if you're bullish, you want this to happen, because what's worse is if you just keep exploding up, then you get an overbought condition. Either way, the sequence would call for some sort of give back, and we are, of course, right at that former high. Typically, before you exceed a high, you contend with the high. Contending is backing filling or some sort of backing away. Laggards. Now, technique for buying laggards, you don't buy a Rite Aid 150 to 9 on its way to maybe 0, or a Tesla going straight down. You try to find something that's at least bottomed. So I want to look at 2 stocks. One is a financial and one is not a financial. Here's Ford Motor. You can draw the line several ways, but one way to draw the line is as follows. We've moved above the downtrend line. That's an important development. And it's also what you would characterize as a bearish to bullish reversal. The 150-day moving average is just starting to flatten. Now compare that, for instance, to Morgan Stanley. It's the exact same setup. Here's the trend line. Again, moving above the trend line, or use a moving average to measure trend, a bearish to bullish reversal. So laggards like this, as opposed to something that's just doing this like a Schlumberger, no thanks. So the chartist, I'll end with this, is a coward. The chartist wants to wait for it to bottom. You go first, and then go with the momentum once it's turned.
Chartmaster. Chartmaster, ACA, Greg Marmalard.
We have
come over, come join us at the desk. Here comes the wall.
We got another.
Holy cow.
This is what's called a party.
Yeah.
What comes before party?
Can we handle this? We have room over here.
I tell you what, there's a lot of firsts tonight, Joe, and
this is
we do.
the two guys in the suits at the end.
I know, right?
good stuff.
All right. So, which you guys are never at a loss for words. Which of Carter's stocks?
Carter, let's talk about financials here. First of all, we've been talking about this bank resurgence. They certainly are a place people look for leadership. Is this that moment we've been waiting for?
Well, it's more of the catch-up trade that you were referring to. It's not leadership, right? I mean, financials on a relative basis peaked 6 weeks after the election and essentially after the Trump bump. And industrials, financial materials, all the cyclical trade has been underperforming. In fact, if you look at value versus growth on a relative basis, we're now below the 09 lows. It's basically a growth-led, defensive-led recovery. From September to now, the V, it's been led by utilities on top, followed by REITs, followed by staples, tech. It's all defense. From here, we need more of it, industrials, financials, in order for the market to.
You know what's funny, though? I mean, what I would say to that is if you look at the valuations on some of these defensive names, I mean, right now the consumer staples are on a forward basis are trading
Not
like
cheap.
19 times.
Not
They're
cheap.
not cheap at all.
Mm-hmm.
So it's obvious that this trade has been playing out. People have been going into staples. They don't want to necessarily be in utilities in that defensive end, but they figure consumer names will give them a little bit of growth prospects and at least a bit of a dividend. I mean, so that's
Carter, when you look at the XLF, though, and you go back pre-crisis, we hit those levels, and we talked about the double top. That still scares me. And to assume, when you ask the question, what do you buy at all-time highs? You have to assume that we're going higher. So if you assume we're going higher, it has to be growth names. In my book, it has to be tech, because tech is what's performed.
You had a barbell. You want to stick with something that's steady, orderly, up and to the right, an Abbott kind of thing, and then you want to find some not established downturns, but something that's basing, something like a Morgan Stanley or a Ford. But you don't want to just stay in steep, uncorrected names because you can get a Xilinx-type move that got murdered last week, yes?
So, Carter, I'm curious, the one chart you had up there, or the one table you had up there, showed we've basically been treading water for a number of months here. We've seen this rotation, right? So we've seen some of the idiosyncratic growth in the FANG stocks. Maybe those are leading, or utilities. Are we now looking at a rotation into financials and industrials?
So what would require, while you've got to pick those winners, that's the portfolio manager's job, that's the individual investor's job. But what we know is the top 6 stocks in the S&P are the same weight as the bottom 300. If we have more trouble, a Google type thing, if Apple comes up, it doesn't matter how much rotation you get, we're just going to churn at the highs, yes? Because the math doesn't work if you've heard from all your champions and they're not progressing.
It's interesting, you look at the banks, Joe, and Dom knows this, I know CBW knows. Go JP Morgan, for example. Tangible book in JP Morgan is $57.60. At today's close, JP Morgan is trading 2 times price to tangible book. That is a heady valuation in this environment, I think. Now, you could say they deserve it. That's fine. But how much more can it go in an environment where banks have effectively become utilities? Goldman Sachs, give or take, is trading right around tangible book or maybe slightly above. So I can understand why Goldman is trading. I just think JP Morgan might be ahead of itself.
And granted, nothing to do with technicals, their balance sheets are in the best shape they've been in decades. And yet their provisions for loan loss and everything like are very, very low. That always happens late. Interestingly, the credit card companies all popped last week. You saw Capital One coming to life, Discover. So there's rotation within the group and so forth. But for the market, going back to, think about this, to be unchanged for 7 months and to be up 1% for 15 months, basically the total returns of bonds are beating equities for 15 months, the total return of treasuries and corporates, and you haven't been paid for the risk to be in equities. 2 drawdowns, one of 10% in January, one of 20. If you put a sharp razor on the S&P, you'd be like, hey, fire the manager.
All right, Carter, thank you. You got a middle name, Carter?
Braxton.
We all know that. I could have told you his middle
Is there a number at the end after Worth, too?
Took all the numbers off.
Carter Braxton Worth the 5th or something? Or, huh?
Fourth?
Took them all.
Come on. Oh, you took their Worth. Anyway, Chartmaster, thank you.
Thanks.
Dom Chu, we're just...
I'll see you tomorrow morning. Bright.
Yeah, we're just normal folks.